So tell me, what do you get when stocks, commodities, and cryptos all wobble at the same time? Well, I'll tell you. You get a market that suddenly remembers the US dollar exists and treats it like the emergency exit in a crowded theater. And today, that risk off reflex is showing up everywhere in currencies, in gold, in equities. So in essence, before you place your next trade, watch this.
Why is fast trade execution a must? Because you're more likely to get the entry price you want and the exit price you want. Reliable, rapid, responsive. Join ATFX today and let's get you started.
Good morning, everyone. My name is Francois. I'm your market analyst here at ATFX Africa. And today we are covering three key markets that are all reacting to the same theme: risk off positioning, central bank signals, and volatility that refuses to calm down. And no, this is not one of those calm Friday sessions. This is the kind of Friday where the market says, we've had a long week, but let's make it longer. So let's kick things off with forex, because the pound has had a rough ride. Sterling fell to $1.36, making its weakest level since January 22nd, after the Bank of England held rates at 3.75%, but delivered a tone that markets interpreted as more dovish than expected. The vote is split, which is what really grabbed attention. It was 5-4 to hold rates, and importantly, 4 MPC members wanted an immediate 25 basis point cut to 3.5%. That's not just a dovish hint, that's practically a cut, wearing a disguise. The Bank of England also suggested that risks of persistent inflation have diminished, and downside risk from weaker demand and losing labor markets are becoming more prominent. So sterling isn't just reacting to one decision, it's reacting to the message that future easing is increasingly on the table. And markets quickly began pricing a 50 basis point rate cut during this year. On top of that, you've got political uncertainty in the UK, with questions emerging about the durability of the Prime Minister's leadership following the appointment of a new UK ambassador to the US, a move that is receiving scrutiny due to that UK ambassador's past links to none other than Jeffrey Epstein. So sterling isn't only dealing with interest rates, it's dealing with headline risk. Meanwhile, on the other side of the pair, the US dollar is holding firm. The dollar index is just below 98, near a 2-week high, supported by a broad sell-off across stocks, commodities, cryptos, you name it. Classic risk-off behavior. And the dollar has gained sharply since the US president nominated Kevin Warsh as the next Fed chair, with markets focused on Warsh's presence for a smaller balance sheet and expectations that he would be more cautious on policy easing. So the market is trying to price two things at once: risk off demand supporting the dollar, but weaker US jobs data supporting bets for rate cuts later this year. And yes, that contradiction is exactly why the market feels choppy. Let's look at some charts. So the narrative here is relatively clear. GBP USD has been drifting lower for multiple sessions. Some key levels to have a look at. First things first, 1.355 is a key support area and is being treated as a pivotal zone. Deeper support can be found around 1.345, followed by 1.325. Resistance is also currently sitting at 1.375, followed by the 2026 high at 1.387. Momentum indicators suggest bearish pressure is stretched. The stochastic is near 16, around the oversold threshold. The MACD is below the zero line, meaning bearish structure but fading momentum. So the technical setup is basically saying, yes, sellers are in control, but they may be getting a little tired. So ask yourself, if the psychological 1.35 level breaks, does it turn into continuation or does it trigger a volatility bounce? Now let's talk gold. And honestly, gold has been acting like it's had 3 cups of coffees with no breakfast. Gold rose back to 4,840 this morning after reversing earlier losses. But the bigger story is volatility. The swings that started late last week have continued, and they've wiped out most of gold's year-to-date gains, weighed by selling pressure after repeatedly hitting record highs in January. Now, on the macro side, gold has been pulled in 2 directions. There are supportive factors. A string of weaker US labor data has reinforced expectations of that Fed cut later this year. Jobs cuts hit 108.4 thousand in January. This is the highest for 1 month since 2009. Initial claims also rose to 231,000. ADP payrolls missed forecast. So markets are eyeing a first cut in June. But pressure factors are also in play. Risk of repositioning appears to be rotating away from overvalued trades and towards the US dollar. Selling pressure has also been linked to volatility and profit taking. Geopolitically, gold remains sensitive. The White House emphasized that the US presidents prefer a diplomatic solution with Iran, signaling patience for high-level negotiations, while keeping military options as a contingency. And talks between Iranian and US officials are scheduled in Oman. So gold has one foot in rate cuts and uncertainty, and the other foot in positioning, adjustment, and volatility. In other words, gold is still the same gold. It's just having an identity crisis. Let's look at the charts. Key levels to watch, dip buyers have shown up near that 4,650 level repeatedly. The moving averages are still bullish on both the 4-hour and daily time frame. Key levels here is that 4,940 level, which if reclaimed, puts us back above that 50% Fibonacci level, which would signal renewed topside traction. 4,560, which is the 78.6 Fibonacci level, is our current medium-term support. The stochastic is around 52, which is neutral, suggesting stabilization after prior overbought extremes. So the chart is basically saying gold is consolidating, not collapsing, but volatility is still the headline. Now, shifting to UK equities. The FTSE 100 fell 0.9% yesterday after hitting a record high in the previous session. The driver? Well, that same Bank of England decision that we spoke about earlier, and particularly the dovish surprise in the split vote. The market quickly priced in a higher likelihood of cuts in 2026, and that pressured key sectors. Big movers came from miners, hit as gold, silver, and copper prices slipped. Glencore was down almost 8%. Fresh Nilo down 6%. Antofagasta off almost 3%. Rio Tinto down 2.7%. Endeavour down 2%. Anglo American fell around 3% after reducing its 2026 copper output forecast. Banks also underperformed. Lloyds and NatWest were down more than 5% each. Barclays off more than 3%. HSBC also lower. Oil majors also weakened alongside crude. Shell was down 3.6%. BP down 1.9%. Shell's quarterly profit was slightly below expectations as well, despite a 3.5 billion share buyback. We also saw Vodafone drop 4.5% on slower than expected service revenue growth. So in short, FTSE weakness wasn't one headline. It was sector-wide pressure tied to rates, commodities, and earnings. Looking at the charts, the index fell to around 10,230, which is currently acting as near-term support. Deeper support can be found at 10,080, which is the 38% Fibonacci level. Resistance is currently at 10,360, followed by the all-time high around 10,480. The main question you should be watching for is, well, is this a healthy reset after a record high, or the start of broader risk-off trends in European equity exposure? So heading into next week and today's session, here's what makes the market interesting. The US dollar is holding firm near 2-week highs, supported by risk-off positioning. But weaker labor signals are still feeding rate cut expectations. Sterling is dealing with a dovish Bank of England surprise and political uncertainty. And gold is stuck between rate cuts should help and volatility is forcing position adjustments. And finally, the FTSE is reacting to both rates and commodity-linked pressures. So now ask yourself, does volatility calm down as we move into today's session and into next week? Or does the market keep rotating and forcing adjustments after everything? Because right now, markets aren't just trading data, they're trading mood. And the mood is very selective, seeing that next week, Wednesday, hopefully, we'll get the US NFP report that was supposed to be released today. Additionally, on top of that, on Friday next week, we will get the US CPI report. So traders, I don't think volatility is going to start calming down just yet. And with that, we wrap up your daily market brief. Brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to ATFX.com and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.